What gets me really excited about this space is really around the thesis of this book, Power of Capital, the recognition that our investment capital builds ecosystems. And it's going to do it whether we have an ESG lens or not. So I see an impact investor as somebody who is intentional about how they allocate that capital and whether they're mindful about whether this is contributing to a sustainable economy.
This is Net Learnings, the podcast that keeps finance and banking professionals ahead of the curve. In each episode, we focus on career growth and practical advice while mixing in the occasional war story. Join us as we tap into the minds of leaders and experts at some of the world's most notable financial services firms and enterprises. Let's get started.
Hello and welcome to Net Learnings. I'm your host, Kyle Peterty. We have the absolute privilege today of hosting a very special guest, Asha Mehta. Asha is founder and chief investment officer of Global Delta Capital, headquartered in Boston, where she and her team specialize in emerging and frontier markets. Prior to this, Asha was an investment banker at Goldman Sachs and lead portfolio manager and director of responsible investing at Acadian Asset Management. She's been named one of the top 10 women in asset management by Money Management Executive, and her tremendous pedigree includes post-secondary credentials from both Stanford and the Wharton School of Business. And did I mention that she's also a published author with her book, Power of Capital, an adventure capitalist's journey to a sustainable future, having recently hit the shelves. Asha, welcome to the podcast. We're thrilled to have you.
Hi, Kyle. Thanks for this very warm welcome. I'm really excited and honored to be here. Thanks for having me.
Well, thank you. It's our pleasure. I want to start on a fun note. Maybe you can dive into the subtitle of your book. What is an adventure capitalist?
Thank you. Appreciate the call out to that piece of it. That's certainly one important aspect of what the book is trying to share with readers. It's an adventure around the globe. So the book tells the story of me as an investor, effectively walking around the world, starting in China, going to Vietnam, going to India, and hitting one major country after another, in some cases a region, and talking through some of the incredible investment theses that are emerging from the ground. And those ideas that I came up with in terms of investment strategies, it's informed to some extent by my career, but it's really helped by having those boots on the ground and talking to everybody I can get access to, from heads of state and ministers of finance and ministers of economy to shopkeepers. And my absolute best source of insight when I'm traveling is always the taxi cab drivers. So the adventure capitalist is the person who's walking around the globe and talking about these investment themes and really sharing from that boots on the ground perspective. But it is a book about sustainability. And I think having that language in there around the capitalist approach to sustainability is really important. You know, it's identifying investment themes that help us build a sustainable world, but are non-concessionary in any way. They're very much returns first investment opportunities.
Okay, that's terrific context. And what better way is there to learn really than to be there asking questions of the people that have the best feedback? That's great. I'm curious though, so my rational brain understands that a fund can exist that focuses on both emerging markets and impact investing. But of course, in financial services, we have to categorize everything. So I feel compelled to ask, is Global Delta Capital an emerging market fund that emphasizes impact, or is it an impact investing fund that focuses on opportunities in emerging markets?
And thanks, Kyle. I agree. It's sort of an awkward question to have to ask. Does this fund deliver on returns or does it deliver an impact? And part of the reason why we're building this strategy from the ground up was we firmly believe we don't have to give on either. So in an ideal world, to your point, we wouldn't categorize. But given that the world does tend to work that way, I'd go with the former. I'd characterize our investment strategy as a long-only emerging markets platform, targeting emerging markets because we see tremendous opportunity there. My view is that emerging markets as an asset class are mainstream in every way except investor allocations. They dominate the globe in terms of global GDP and contributions to growth, contributions to the globe's footprint, contributions to productivity. And yet, from an investment perspective, it remains a small portion of institutional investors' typical asset platforms. So we're building this firm with this view that emerging markets are very much the asset class of tomorrow. And we don't see, again, sustainability or impact in any way at odds with our central objective, which is to maximize risk-adjusted returns for investors. We do so in a way that's data-driven. This is a systematic investment strategy. So we're literally evaluating every security that prices across the globe, from China to, the microfinance stock in Ghana, for example. So literally every security. And those sustainability and impact aspects, what they do is they help us get a better, more holistic view of how companies are positioned. So again, integrated in a way that adds value to investors.
I can't wait to pull on that thread a little bit more. And we'll circle back to impact investing in a moment. But I think it would be beneficial for our listeners and even maybe for myself if we talked about emerging and frontier markets and even traditional markets for that matter. Like, how would you explain the differences and similarities between these markets as if you were speaking to a non-finance person?
Sure. So just to step back a bit, typically when investors make allocations, they think about their home biased allocations. So what are they investing, in this case, in the US versus their international allocations. And as I said, EM, emerging markets, tends to be kind of a small orientation relative to international. So perhaps they're opportunistically in EM. So the world tends to think here's home, international, EM. International and developed markets are almost synonyms with each other. And in fact, there's this third classification, as you just mentioned, developed markets, emerging markets, and frontier markets. And I think you're asking, how do we make this distinction between an emerging market and a frontier market? And at a broad scale, the simple difference is that frontier markets are at an earlier stage of development than emerging markets. So that's how I think about it, just sort of in terms of very digestible terms. The reality is that emerging markets are much, much greater than frontier markets in terms of number of countries, number of securities, much more liquidity in that asset class. Hence why, many investors broadly are not even aware of the frontier markets asset class. But I think what's really interesting to point out here is that within EM, some people think of frontier as a part of emerging markets. There's a lot of heterogeneity, not just by countries, that China looks a lot different from Nigeria, for example.
Right.
But even in terms of market cap, that large cap emerging market securities trade much differently than small cap emerging market securities. Small cap securities, like frontier market securities, tend to be more inefficiently traded. So the asset class broadly is inefficiently traded. There's less institutional participation, so there's more mispricing. So it means the EM asset class offers good opportunities for active stock pickers. But in these even less efficient parts of EM, like frontier and small cap emerging, there's even more inefficiency. So the way we look at it, there's twice the inefficiency in these kind of pockets of emerging markets than there is in EM broadly.
Interesting. And actually, I wanted to ask about that. Was it something of like a geographic arbitrage opportunity because of liquidity or because it's less picked over? Or is there another element too in emerging or particularly frontier? Is there also higher return potential because there's just a lot more runway?
Yeah, I think of it as a base effect. They're at a lower base, and so a modest improvement can have a very significant, impact from a return perspective. I want to be careful how I answer the question, because I wouldn't necessarily say that frontier is a higher return asset class than emerging markets. Frontier markets are marked as frontier for a reason. They're at the earlier stage of development, and as I said, they're less liquid and they're more challenging to invest within. So for example, in a less liquid asset class, transaction costs can be much more expensive. In an asset class like frontier markets, the transaction costs can be so high that they can often just eat up all of the alpha. Another important consideration in this asset class that's less developed is that many times there are uncomfortable capital controls that are introduced within this market. So we kind of dabble in frontier markets. I've invested in frontier heavily before I actually launched the first institutional frontier strategy, and it was a phenomenal strategy for the last decade. The good news and the bad news is that the opportunity looks different ahead, and I think one of the important reasons why frontier has kind of run its course, at least for now, not to say it doesn't come back, but really the objective of a frontier economy is to become an emerging market economy. It is to evolve and to get upgraded And over the last decade, we've seen some tremendous examples of countries that have received that upgrade. That's a huge investment thesis in and of itself, to be early to frontier economies that are going to be upgraded. But ultimately, I see the return potential as really within the asset class broadly emerging, but especially in those pockets of the world, and I'd say small cap emerging even more so than frontier today, be in those pockets of the world where there's just more pricing inefficiency. Right. Sorry, I'll make one more point because it's an interesting theme, especially as we trend towards sustainability. Another reason why the small cap space within emerging markets is so interesting. So the first one I already mentioned, you've got less institutional participation there, more mispricing, more opportunity for return generation, easier to kind of separate the winners from the losers. The other reason why the small cap space is so interesting is because that's where you'll have more of the consumer themes expressed. The large cap stocks tend to be large energy companies, metals and mining, perhaps the large established banks. But where you see a lot of the innovation, whether it's, from a renewable technology perspective or new consumer offerings or fintech, a lot of kind of these more technological solutions are more present in the small cap space. Again, win-win, because you're getting exposure to these themes of tomorrow and also picking up incremental alpha opportunity.
And you touched on the sustainability bit. So that's kind of an interesting segue. And I want to dig into some ESG and kind of impact sustainability questions. Now, there are going to be supporters of ESG and impact investing in the CFI community, and also folks that may be skeptical about the efficacy of or rationale behind using a sustainability or an ESG lens to even make capital allocation decisions. So in your words, just to set the stage, how is ESG different from impact investing, and are there common threads?
Sure. So I think of kind of the umbrella term, and we all use these terms, in different contexts, which is part of the reason why I think we have this pushback against ESG today. It's kind of been a nebulously defined space.
Totally.
But the term that I use that kind of overreaches all of these themes within it is sustainable investing. So again, a very broad term, but it helps to kind of use this umbrella phraseology from time to time. And to give a little context, Kyle, I've been very active as a systematic manager for a couple decades now, as a returns first emerging markets investor for a couple decades. And similarly, I actually signed on, I brought the first quantitative manager to sign the PRI back in 2009. So I've been deep in this sustainability space for a long time, and I've seen it evolve substantially. But at a high level, let me answer your question. So ESG versus impact within the sustainability space. To me, ESG means integration of environmental, social, and governance factors. It's really, as an investor, are you willing or are you not willing to take these considerations into account? Do you believe they are material? And if you believe they're material drivers of return and they will positively impact your portfolio, then you're an ESG investor. Impact is almost the other side of it. Will your portfolio positively impact the companies you're investing in or the communities you're investing in?
Okay.
So it's just the other side of that piece of it. I think ESG has become very well defined over the last decade, and we're really in the earliest stages of bringing impact to scale. Impact investing historically has been concessionary in nature. It's tended to involve very concentrated investments, typically in community investments. I think that notion of impact remains. But what gets me really excited about this space is really around the thesis of this book, Power of Capital, the recognition that our investment capital builds ecosystems. And it's going to do it whether we have an ESG lens or not. So I see an impact investor as somebody who's intentional about how they allocate that capital and whether they're mindful about whether this is contributing to a sustainable economy.
That's a really nice perspective, actually, and helpful. I appreciate that. Kind of want to change directions a bit here, talk about asset management. And maybe this is a little bit basic, but when I hear fund, I think of a pool of capital that's managed by a fund manager who makes capital allocation decisions. And I'm hoping you can help me and our listeners better understand just the basic mechanics of how a fund works. Like, are you taking on new investors on a rolling basis, or is it kind of closed? Do investors commit capital, sort of like a venture model, or do they turn over their funds right away? Like, just how does it work?
Yeah, my sense is that every investor is going to do it a little bit differently. But
Fair.
in broad strokes, I see this kind of commitment model as more a model that takes hold in private asset space. So if you're investing in sustainable infrastructure, private equity, VC type investment funds, that's where you commit a pool of capital and the GP will pull on that capital as investment opportunities arise. That's in contrast to what we're doing here at Global Delta, where we're in the listed long-only equity space. Again, these are securities that price every single day. And so the liquidity profile of an equities fund, a public equities fund, will be very different from the liquidity profile of one of those committed structures. So that's a kind of long-winded way of answering that. Effectively, we're offering monthly liquidity. Investors are able to come into our fund on a monthly basis. And similarly, if they wanted to redeem or exit, it would be monthly liquidity available to them.
That was going to be one of my questions too. Is there like a notice period just to help you manage liquidity and duration risk?
Yeah. So we do request our investors provide us on the order of 30-day notice. And that's right. It gives us a little bit of visibility to how we're going to shift our portfolio. But again, that's the beauty of being in the public equity space. The liquidity is there. And I think one novel aspect of having an emerging market systematic strategy is that we're able to access those small cap, less liquid stocks in the emerging market space, less efficiently traded, so higher alpha, but it's not no liquidity. And so I think this is a really unique place within the market where you're getting some level of liquidity and almost private equity type returns associated with it.
That sounds very compelling. Running a fund requires, obviously, I would think, a strong team. So what sort of characteristics are you looking for when you're rounding out your team, like hiring new members?
It's interesting. I spend a lot of time talking to people early in their careers around what skill sets they should be developing, as they pursue higher opportunities for them. And I can talk you through some of those kind of core skill sets that I often encourage investors or individuals to adopt. Before I do, I just wanted to highlight that some of the most important criteria are really the softer skills. And in fact, it's the softer skills that will typically disqualify a candidate. So, first and foremost, do you believe, in the context of our strategy, do you believe in systematic tools? Are you a data-driven investor? Do you believe that effectively leveraging the power of computers is an effective way to forecast returns? Do you believe sustainability is a driver of returns? That's a very philosophical question.
Right.
Even beyond mission, trust. Can I trust this person? Does this person trust me? Good humor. I'm going to spend a lot of my life with this person. So, do I get along with them? Do they have an optimistic mindset? Will they fit culturally within the team? So I wanted to highlight that so much of this is really about the softer skills. Having said all of that, the harder skills matter very, very much. And in our space, and I think this is evolving across the industry, we're really looking even on in functions that don't require coding skills or data science skills. We need to be working with people in our organization who have familiarity and comfort with this language and with that type of approach. And on the investment side, it's certainly data science driven. Finance, having an understanding of what moves companies, what are the fundamental drivers of value, how do we evaluate a security in the tech sector versus a security in the resources sector. Having some of that kind of core financial background is important as well. And then a final piece that I would speak to, and it's probably specific to kind of where my firm is in its development, but you've got large shops out there who are looking for an individual to contribute to a piece of the process. And then smaller organizations where we ask people to take on many hats. And so one area that we're really looking for, again, it speaks more to that softer side again, but do you have a startup mentality? Can you roll up your sleeves and kind of jump in any function? I find that people find that type of opportunity very rewarding, a lot of growth opportunity there, and can be personally very fulfilling. But not for everyone.
Yeah, no, that's terrific perspective. You've alluded to the fact that, you're looking for alpha and you're looking in places where things are not traded as efficiently. And of course, that requires you to make investments all around the world. And I guess one of the things that I'm really curious about is when it comes to regulation. I'm sure some of these markets don't have the same level of robust regulation and like listing standards as you might for, say, the NASDAQ. So how do you think about and manage those risks? Or am I way off base?
I don't think you're way off base. I think it's a relevant question, and it's a question that I receive very frequently. It's typically the first question I get when I say I'm a data-driven investor in emerging markets. And then you layer onto that with a sustainability lens. Where do you get the data? Is there even enough data? I mean, for a financial statement alone, people wonder if there's the data. But then what about, on the ESG side, how can you figure out companies' relationships with their customers and the suppliers? Is there enough data? So it's a very fair question. And then you add on the regulatory component as well. Let me answer it two ways. One, by saying I think that it's a fair question, but rapidly changing environment. When I started investing in these markets about 15 years ago, there was quite limited access to information. And you mentioned frontier markets. In the frontier market side, for example, there were just a few hundred companies that were covered by major data providers like Bloomberg or WorldScope. Fast forward to where we are today, and it's literally thousands, like on the order of 5,000 securities. So it's just exploded in terms of simply the number of companies that are covered. And that is a consistent trend across emerging markets as well, and across data items. So back then, you'd have robust coverage of revenue and profits. But today you can get much more detailed on the financial statements. And that's just a function of the fact that we live in the era of big data, and data is easier to digest, easier to collect, easier to access today. But even from an accounting standpoint and a credibility and integrity standpoint, it's a similar trend. So what I just talked to in terms of data points was quantity of data, but the quality of the coverage has improved materially as well. Again, it comes back to this notion of our investment capital. By being investors in these markets, we are truly driving development within these markets. And therefore, these are poorer countries that are looking for foreign capital because they want to develop. What that means with respect to accounting practices is that the nature of fraudulent events and sort of misaccounting, or, there's simply being a shell company that's nothing beneath it, the likelihood of that occurring is dramatically lower than it used to be. Here's one kind of objective way to look at that framework. IFRS, the IFRS accounting standards have been adopted en masse across the emerging markets and frontier markets in the last 15 years. So generally speaking, fair question, but I think, as I said, these markets have become mainstream and they've evolved substantially in the last decade and a half. But I also, it remains something that we want to be mindful of. And so to that end, we do use pretty robust screens on accounting quality. We have ways to assess how aggressive the methodologies might have been to develop the figures that are presented. So we're constantly restating the financials that we receive to ensure that, investors have, or the corporates haven't cooked the books. And similarly, because accounting standards, even within IFRS, can differ from country to country, we'll evaluate a company relative to another company within its country so that we're running an apples-to-apples analysis. So very fair, we account for it, but maybe increasingly less fair, if that's okay.
No, that's a very good point. And I mean, it's not to say we don't have very high-profile fraud cases here in more traditional markets and very well-developed financial markets. So we don't need to get into them. There's been some very lately, actually. So yeah, thanks for answering that.
And IFRS hasn't been adopted here in the U.S., for example. We've been one of the holdouts. We and Argentina are the two major ones that I follow that have held out.
Coincidence? I don't know. We don't need to go down that road. But good point. So here's a question. We're in a rising rate environment, have been for some time. Perhaps that's stabilized. Do rising rates impact operators in emerging and frontier markets differently than more traditional markets? And I guess similar question around inflation.
Yes and no in terms of how much does the tightening environment, the high inflationary environment in the U.S., is that adverse to emerging markets and frontier markets?
Yeah, that's sort of what I'm getting at, yeah.
And it's very situation specific. So the asset class, we haven't really touched on this much. We've talked about distinctions between EM and frontier, which speaks to the heterogeneity, speaks to the fact that, not all emerging markets are alike. And I'll get a little technical here, but in developed markets, the correlation between a developed market country and another one, so the US and the UK, for example, tend to be pretty high. So about 75%. You can kind of guess if US markets are down, UK markets are going to be down. emerging markets have a much different profile. The correlation of returns across countries in emerging markets, I keep coming back to China and Nigeria, but let me not go there for a moment. China and Brazil, the correlations will be more on the order of 50%. So you got a 50% chance they're going to correlate. I didn't go to Nigeria because then you're down to 25%. And that's one beauty of the frontier markets is they're very diversifying within a balanced plan. So, does the environment here, does it affect EM positively or negatively? I'd say the answer is it really depends. It depends on which countries we're talking about. And that's one reason why I'd always advocate for an active approach to emerging markets. An active approach allows you to not only differentiate the winners from the losers from a stock picking perspective, but it also allows you to transition in and out of countries based on where the risk profile is. And in this asset class, emerging markets, far and away the greatest source of risk is country-specific risk. So now to get to the answer, I've kind of given a little context, but how is it helpful, in fact, to be in a tightening environment, in this environment where inflation is higher than it's been in a generation? How could that be helpful to emerging markets? It's helpful in several ways. One would be growth. Here we're talking about a recession in the U.S. So how do we go out and find growth in our portfolios? We're going to have to look more broadly. Over the last decade, there's really been a single strategy that's been effective for portfolios. It's been one country, one sector, and a handful of stocks, very concentrated. So for the next decade, as that particular sector and certainly that particular country is going to have a more challenging pathway to growth, investors do have to think broadly. But the other important aspect here is the U.S. is tightening. Other markets are not. In fact, China is in an expansionary phase right now. So China's kind of got its own set of issues, but one reason to have exposure there is because it remains not only a high growth market from a macroeconomic perspective, but from a market perspective as well. It continues to be high growth. But again, not all EMs and FMs are treated the same. I don't want to be overly dismissive. In this higher rate environment, countries that have significant exposure to U.S. or U.S. denominated debt, they're going to struggle. And so that's where it is important to have kind of this active approach to country selection.
Wonderful. Okay, thanks for that. So I'd like to ask maybe a couple of career-themed questions, and I think that'd be very high value for our listeners. I can't count how many young finance people tell me they want to work in investment banking. And you alluded to this earlier. You talked to a lot of folks young in their career. Well, you started your finance career in investment banking and at Goldman Sachs. And I think that's sort of like a holy grail for a lot of, finance students looking at their career trajectory. And not very many people get to peek behind the curtain in terms of what goes on there. So what was it like at Goldman?
Interesting. Well, let me just start by saying I was there a couple decades ago, more than a couple decades ago. And
Fair enough.
It may very well have changed in the time since. And in looking back, I actually speak very highly about the experience. I think it's an excellent training program for individuals who are interested in exploring a career in finance, just the technical training and the opportunity to sit with companies and to see how a financial spreadsheet comes to life in a true strategic context is unparalleled. It's an incredible experience. I think, the misconception is clearly the glory. It's really challenging work, which I'm sure people who are looking for a career in investment banking probably know heading into it. It's very long hours. It's very grueling hours. You'll ask yourself time and time again, why am I doing this? What is the purpose of the work behind this? And is this really kind of setting my career in motion? So I'd say that's the highest piece. And certainly my experience didn't resonate with what I see in the movies. It was a lot of sitting behind a desk very, very late at night working through spreadsheets.
And back early in the morning.
That's how you learn. That's right. That's right. You make it home by 12, 1, 2, and you're right back out there, 8, 9. And Kyle, I know you spent time in banking as well, so you know all about that.
Not investment banking, a little bit more palatable hours for sure in what I did. Okay, so maybe a little bit of a different direction. What's the biggest miss or regret you have about your career? Like maybe a company that you didn't pull the trigger on or a deal that went wrong. Like, would you be willing to share kind of a war story?
Sure. Happy to share challenging moments that I had in my career. One example might be, for example, when I've mentioned sort of the upgrade of frontier countries to emerging market countries. That's a really important trend. When countries are upgraded from frontier to emerging, there's just a natural pool of capital that moves into those upgraded countries. It's a function of the benchmarks. There's much more money following emerging market money than frontier market money. So just from a passive standpoint, you know that's going to be a huge return opportunity. Active money follows passive money at a much more aggressive rate. So for every $1 of passive money that moves into this theme, $5 will follow. So being early to these upgrade effects is really important. And knowing when to time out of these upgrade effects. So, I'm a systematic investor. I'm looking at my process to inform me when's the right time to buy into one of these upgrading events and when's the right time to sell down. But the reality is there's a good bit of judgment that's involved as well, because you can only be a data-driven investor and a statistically led investor if you have enough data, right? You can only get statistical significance with enough sample.
Right.
And so one really, really challenging part of the work we do is finding that line between when is this a judgment call and when is this, a call where you trust the statistics. And I had gotten a couple of these events correct in terms of being early and capturing the wind, having the wind behind my back into one of these upgrade events. But then slowly markets became more efficient, and the timing around when do you move into these and when do you sell out changed. And so I found myself in an environment where I wanted to change the process. And it was very challenging. The investment industry is challenging business, and a lot of this has to be done via teams. You can't work as a solo actor. And so to work with my team to get the timing right on this, very challenging aspect. Again, we kind of came at this idea around when do you lean into a judgment versus when do you trust the data very differently. And we missed the opportunity. We sold out of an upgraded country too late, and a lot of the return we had picked up, we lost on the way out. And that was really challenging for me as an investor to recognize that there had been a breakdown in team communication, misalignment in terms of our expectations and processes. And ultimately, it was the underlying investor who suffered as a result. So that was frustrating. And what it really brought me to realize is where I talked about before, when you build a team, what are you solving for? You are looking for some level of cognitive diversity. You need multiple views in the room. That is the reason why you have a team, so you can complement each other. But there has to be a certain level of alignment in terms of, approach and mission. And that was why part of the reason why, we can very respectfully believe that there are multiple ways to skin a cat. There are multiple ways to build an investment firm. Global Delta Capital is a relatively new venture. And we've built this new venture because we see a philosophy that diverges from our legacy firm. So I think that's very inspiring. We see, again, multiple paths to success. And my team and I are out there trying to build our own independent path as a result.
Sounds like quite a delicate dance. And thank you for being transparent and open about that. We certainly appreciate it. If you and your team weren't running your own fund, what would you be doing?
It's so interesting to ponder this question, because I'm truly passionate about what I do. And I have landed in this space over and over within my career, looking for purpose in my work, seeing the power. It sounds cheesy now that I wrote a book with this title, The Power of Capital. Seeing that investment capital, we all know that money makes the world go round. We all see it in our daily lives, what we do for our jobs and, the capital we need to live the lives we want to live. So money is real, and being able to use that to build a sustainable ecosystem, I think, is really, really inspiring. I started my career actually as an intern in microfinance. I fell into ESG investing about a decade later, and then here I am now running a strategy that leans toward impact. So it's hard to think what I would be doing otherwise. I began my career at Stanford. I studied biological sciences and anthropology. My parents were doctors, and they really wanted me to be a doctor. And the way I fell into microfinance, in fact, was I was in India working on a summer project to distribute vaccines to rural areas. And when the funding fell through, I had to reorient, and I learned, or I saw while I was on the ground there, I'd gone there for a healthcare project, that what these people needed was not health as much as wealth. So that's why I ended up transitioning the way I did. But if I could have studied whatever I wanted without the pressure of parents in college, Stanford then offered a degree called Symbolic Systems, where they brought together, as a multidisciplinary degree, linguistics, philosophy, psychology, and computer science.
Wow.
All fields that I find really fascinating, and you put them all together. Quite honestly, that was Stanford right around the dot-com boom. That's the beginning of the AI movement. That's the beginning of automation and bringing intelligence to technology. So I think if I wasn't here, if I hadn't found my way into finance and investments, I probably still would have leaned into data-driven processes, and perhaps I'd be part of that movement calling for the usage of technology and AI in responsible manners.
That's a nice caveat at the end. Responsible manners.
Yeah. And I mean that very sincerely. Actually, in the book, Power Capital, I talk about several examples where technology has liberated populations. It's given voice to people who otherwise wouldn't have had it. It's democratized countries that otherwise wouldn't have allowed it. Now, the converse of that is absolutely true as well, right? In many of these countries, as a result, you've seen authoritarian governments crack down even more. And so there is this very real tension around how technology can dramatically improve people's lives and how it can, virtually and in effect, in reality, crush their lives. And so I'd love to be in another life, perhaps a part of that movement toward wielding technologies in a responsible, sustainable manner.
What a great answer. Thank you for that. Where can people go to learn more about you, your book, or the work you're doing at Global Delta Capital?
Terrific. Come visit us on our website. All of our contact details are there. You can learn about the book at powerofcapital.com and learn about the firm at globaldeltacapital.com.
Wonderful. We'll be sure to include those in the show notes. And I actually have my copy of the book. I look forward to reading it. It arrived recently, so I'm really excited. This has been an absolute pleasure. Honestly, thank you so much. Very insightful conversation. I appreciate you sharing your time and your experiences with us.
Thank you. It's been such a delight. Thank you for having me.
Thanks for listening to this episode of Net Learnings. This podcast is powered by CFI, an organization on a mission to enhance the skills, knowledge, and productivity of finance and banking professionals. If you enjoyed what you heard in this episode, make sure to follow Net Learnings wherever you listen to your favorite podcasts, or visit us online at corporatefinanceinstitute.com/podcast. See you next time.